In this week's video, we'll review numerous charts that say a lot about the stock market in 2018 and beyond. This is a daily chart of the Dow Jones Industrial Average. This is 1983 on the left side of your screen, and we'll eventually make our way all the way out to the present day on the right side of the screen. The Dow consolidated and stayed inside this box for 5.95 years. And we know the longer a market goes sideways, the bigger the move that we can expect to get once we either get a bullish breakout or bearish breakdown. And obviously, in this case, we had a bullish breakout and a retest here at point A. The longer a market goes sideways, the bigger the move that we can expect to get. It's a 299% gain from point A here to point B. We're also familiar with the expression, the market needs to consolidate its gains. Since Kathy and I were working on Wall Street in the year 2000, I can tell you not many people thought the right side of this chart in the year 2000 would look like this. If we compare the two boxes, this box is bounded by the highest high and the lowest low. Similar situation here. This blue box is bounded by a highest high here, and then it was followed by a lower low, and the box is bounded by that lower low. In this case, our entry point, or our point to count the 5.95 years, starts when price enters the bottom of the box. If we use a similar methodology here where price enters the bottom of the box, note this point here is the same as this low. This point here is the same as this low. And eventually, on the top of the box, we stop our count where we get a successful retest at the top of the box. And we'll do something similar here. We get a bullish breakout, and we consider this to be a retest because we're coming back down towards the top of the box, and price was able to hold above the highest high. Price was able to hold above the original highest high here. Therefore, if we count on this box in a similar manner to the way we counted in this box, this consolidation period from the entry point to the retest is 19.28 years, which is roughly 3 times longer than this box here. And we know the longer a market goes sideways, the bigger the move that we can expect to get. Since this consolidation period here is quite a bit longer than this consolidation period here, it tells us to be open to a gain that's larger than 299% and a gain that lasts in this direction for more than 9 years. We're not making a forecast here. We're simply making probabilistic statements based on the facts that we have in front of us. We can see these facts, measure them, and put them in a model as of December 21st, 2017. And we know from past videos that the concept of market fractals, that concept applies here, telling us that this consolidation period, or any sideways consolidation period, should be treated in the exact same manner as this longer period here. As of Friday, December 22nd, 2017, it might be very, very easy to dismiss this consolidation period, the bullish breakout, and the retest here. Let's backtrack roughly a year to see what we can learn about this long-term consolidation box. Let's take a moment to review some historical charts to try to get some idea of where we are at year-end 2017. It may seem like a distant memory now, but this is the chart of the S&P 500 on February 11th, 2016. This is the 200-day moving average here rolling over in a bearish manner. This is the 50-day moving average trying to recapture the 200, and it was rejected. Prices below both moving averages and the slopes of both are down. This is calendar year 2014, 2015, and 2016. This volatility and sideways movement in here allows us to classify this as a harder market. This is not a favorable look from a probability perspective, In fact, we can make an argument that it looks similar to this point in here. After we could see all of this from point A here, really bad things happened in the stock market with an additional loss of 47%. And given the fact that if we lose 47% on $1 million, our portfolio will drop to $530,000 down here. We would need to make, from this point B here, 89% just to get back to break even. When we're in the middle of a bull market, as we are today, it's very, very easy to make direct comparisons with the S&P 500. But we also have to remember, if your goal is to beat the market, from this point A to this point B here, you could have lost 46% and you would have beaten the market. Under our approach, this is a low probability setup and we want to protect our capital. This is a tweet from Friday morning, December 22nd, 2017. Is it accurate to say the markets have been steadily rising with no volatility for an eternity? Well, this chart here tells us the answer is absolutely positively no. This is a very, very difficult period marked by high volatility. This is our proverbial harder market. And while feelings and emotions may make it feel like there's been no volatility whatsoever in the rearview mirror, many have already forgotten that the S&P futures went limit down after the Brexit vote. This is maximum fear in here on June 27th, 2016. Once again, we do not have to flip the calendar pages back that far to find a difficult and harder market. This is 2014, this is 2016. We can draw numerous horizontal lines that will touch price. Numerous horizontal lines that will touch price. Numerous horizontal lines that will touch price. This is what consolidation or a more difficult period looks like. How is that relevant to December of 2017? It's also easy to forget that the chart of the S&P 500 looked very, very concerning and ugly in early November of last year. We had a bullish breakout and then what looked like a failed breakout. And we know when you fail at the top of the box, you can move to the bottom of the box. And not only did the futures go limit down after Brexit, they also went limit down. We had maximum fear and maximum overnight volatility as recently as November 2016. Once again, it's not really accurate to say we have had an extended period with no volatility. We took the same chart. This is the exact same chart that we covered in a December 9th, 2016 video. And in that video, we said harder markets are typically followed by easier markets. On December 8th, 2016, we made a higher high above this high here, telling us now to be open to a successful bullish breakout from this long-term consolidation box. And just as we're discussing in this week's video, when we see consolidation followed by a breakout, we know the longer a market goes sideways and harder markets are often followed by easier markets. We covered this chart on December 9th, 2016. It might be helpful to go back and look at that clip and then think of what was said a year ago in the context of the charts that we've covered in this week's video. So let's go to the videotape from the CCM December 2016 vault. When we move out to a longer time frame, this is 1989 here, this is 1998. The consolidation periods are the periods where you focus on capital preservation over growth. Then when the odds are clearly in your favor, now you switch to a growth bias over capital preservation. And the way that you manage risk is if the information that you have in hand changes, then you just revert back to a capital preservation strategy. Given on December 8th, 2016, we knew these expressions applied to the present day market. None of us should really be surprised that the harder market was followed by an easier market in 2017. In fact, an easier market was exactly what we were expecting based on probabilities and this consolidation. So how does all of that help us today? Just as in December of 2016, we said to take the bullish breakout and what ended up being a retest seriously once a higher high was made, the chart pattern that we have in front of us today that we can see, measure, and put in a model as of December 21st, 2017 should be taken seriously as well. The only difference between this breakout and the breakout we covered in the S&P 500 a year ago is that this sideways action is much, much longer in duration in terms of years, telling us to remain open to better than expected outcomes. Similar situation in the NASDAQ daily. 1983 here will eventually make our way all the way out to 2017. 3.8 years of consolidation, a bullish breakout, a little retest here at point A. Just as the chart a year ago told us, the longer a market goes sideways, the bigger the move that we should expect to get. The stock market rallied for 9 years and tacked on 976% from point A to point B. And it's extremely important to keep in mind, to capture a very satisfying gain, or even a portion of a very satisfying gain, we didn't have to own the hot stock of the day or the hot stock of the year. If we owned a technology index or ETF, we would have done very, very well with some discipline and risk management between point A and point B. We also know at some point the market needs to consolidate its gains. This point here is very, very similar to this point here. If we fast forward, the market did indeed consolidate its gains. In fact, from this point here to this point here, the NASDAQ went absolutely, positively nowhere for 16.66 years. It's very, very difficult to use the term bubble or to say a market is extended when it went nowhere for 16 years. And just as the chart of the S&P 500 that we covered roughly a year ago, before and after the U.S. election, told us to be open to better than expected outcomes, the longer a market goes sideways, the bigger the move we can expect to get. Some simple math on the back of the envelope tells us that 16.66 years is 4.38 times longer than 3.8 years, telling us this rally could last longer than 9 years, and the order of magnitude of the gains could be greater than 976%. Those are probabilistic statements that just tell us to be open to better than expected outcomes, not a forecast in any shape, form, or fashion. As always, we'll take it day by day and manage based on the hard data that we have in front of us. We would also learn something if this breakout failed. And when we have secular bullish trends, our goal is to capture as much as prudently possible of the gain between a point A and a point B that could be several years down the road. And this example here reminds us that volatility was part of the equation between this point A and this point B. And even if good things happen for a long, long time, there is going to be volatility between this point A and this point B. We also know that it's going to take an incredible amount of discipline to navigate from any point A to any point B. And market fractals tell us no matter how long the consolidation period, the concept of the longer a market goes sideways and harder markets are often followed by easier markets also applies to this December 21st, 2017 monthly chart of the value line geometric index. The longer a market goes sideways, in this case, the market went absolutely, positively nowhere for roughly 19 years from this point A to this point B. Once again, very, very difficult to logically make the argument that the stock market is in a bubble when the average stock has made no progress for 19 years. The longer a market goes sideways, the bigger the move we can expect to get when we either get a bullish breakout or bearish breakdown. Right now, we have a bullish breakout that just occurred in calendar year 2017, telling us the longer this holds, the more relevant it becomes. As we move forward, we'll make our decisions based on the weight of the evidence tracked by the model. And given the average stock went nowhere for 19 years and the look of this pattern, it's a good time to review this quote from Market Wizards. There is another point that I think is as important. You should expect the unexpected in this business. Expect the extreme. Don't think in terms of boundaries that limit what the market might do. Expect the unexpected, expect the extreme, and don't think in terms of boundaries, as long as the weight of the evidence supports those statements. And those statements apply to our approach. Yours may vary. When we see a chart like this, if stocks are going to move in this direction, we would not expect an economic recession to be right around the corner. And the economic data that we have in hand, including new home sales that came out on Friday, are not pointing to an imminent recession. There's some interesting economic bullet points here relative to recessions and housing starts. You can pause your video player and read this information from Sam Stovall. The charts that we've covered in this week's video, including this chart, are forest charts. How do the shorter term tree charts look in late December 2017? If we use the 50 and 200-day moving averages for illustrative purposes only to illustrate basic concepts, does the present day look anything like this low probability look here that we could see, measure, and put in a model before the S&P 500 lost an additional 47% from point A to point B? And does it look anything like this harder and volatile market that looks vulnerable when we review the same 50 in blue and 200-day with volatile price removed? The answer is obvious. Some quick points about volatility that might be helpful when the markets are calm. Number one, volatility is not the enemy. Number two, volatility is 100% normal and to be expected and a part of any bullish trend. The odds tell us 2018 will most likely be more volatile than 2017. For example, we would expect sometime in the next 90 to 120 calendar days that the S&P 500 will pull back somewhere between 3 and 6%. Once again, not a forecast. All of these concepts apply to short-term time frames as well. So on a shorter-term time frame, easier markets, low volatility periods inevitably have to be followed by some consolidation and volatility. Therefore, we should be mentally prepared for some volatility sometime in the next 90 to 120 calendar days. It shouldn't surprise any of us. In our case, we will trust the hard data, the model, and our disciplined approach, and we will continue to take it day by day and go with the flow as new data surfaces. track all of this and convert it into a usable and actionable format in a reasonable amount of time. The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.